Hello, everyone. Thank you so much for coming today. My name is Marcia Butler. I'm the webinar director here at Advice Chaser. We're so glad that you are here. Before we introduce our guest and get started, I need to do a bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. We're thrilled to bring you this educational presentation today. Attendees are muted, but we do encourage you to ask questions using the chat box. That is a feature I'm going to turn on right now. All right, that is turned on. The presenter will answer those queries during or after the presentation today as appropriate. If you ask a question in the chat box, go ahead and leave your contact information as well. And if we can't get to your question during today's webinar, we'll make sure someone reaches out to you after the event. We want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. I'd love to introduce you to our presenter today. With over 20 years of experience as a financial professional, Erwin Matthews has practiced as a CPA with a Big Four public accounting firm, operated a tax practice, and now advises individual and small business clients. His career as a financial advisor started with American Express Financial Advisors, where he became a franchise owner and branch manager. He built a successful branch with 6 advisors while managing $30 million, while managing a $30 million practice, He achieved many accomplishments in his 10 years with the company. In 2004, he transitioned his practice to Merrill Lynch as a senior financial advisor. And with Merrill Lynch, he managed his personal practice and was a partner of the 50 billion corporate and institutional advisory team, the largest team in the company. In May 2009, he became independent and launched One Source Advisory, which represents the firm that brings the client all the key services and experience from one source and allows him to deliver a more comprehensive service to the client, including leading edge and unbiased solutions for the client's most pressing needs. Erwin, we're really excited to have you here today. And this is a great topic. I'm going to go ahead and turn the time over to you.
Well, thank you, Marcia. It's a pleasure to be here and welcome guests. Today's topic, investing and wealth accumulation, one of my favorites. And I'm looking forward to spending time with you to delve into the particulars around how to make this work for you and make it be a successful journey. So when we talk about wealth accumulation, in my experience, what I've found over the years that I've been practicing as a financial advisor is that the ones that have succeeded in this process really understand some foundational information, but most importantly, they see it as a journey and not a one-time event. So when you talk about investing, you want to first start with focusing on your goals. What are you trying to accomplish? And then you want to look over time. What are the risks? What are the potential rewards with staying the course? And then ultimately, you want to make sure as you build your financial future, you're focused on protecting and preserving your wealth. And we'll get to specifics later on what that really means for you. It's important to know what you want from your money. So we talk about an asset test. Let's start with the end in mind. What are you trying to achieve? How much time do you have to work with? And then we can kind of help back into what's a more appropriate investment strategy for you to take. What are you trying to accomplish? I've seen over the years, the goals may vary. A younger couple may be focused on just trying to save to purchase a home. or if they have kids, it could be focused on building funds for college education. And like most of us, ultimately retirement. Those are going to be some common goals that you see individuals have focused on planning. And it's important to know your time frame, how much money you're working with, and then what other issues that you need to be concerned about as you move forward. Factoring in market declines, you have to figure out what kind of investor are you? Are you going to lose sleep at night if we have a down market? We can talk about that, but that really depends on your needs. If you don't need the money for a long time and that market decline affects you, then maybe you're not as aggressive as you thought you were. That's something you want to speak with your financial professional about. Your portfolio. So there's a lot of different options when you talk about risk. Again, building with the amount of time that you have, you want to build your portfolio, your investments around your time. The higher risk typically will give you a higher return, as the old saying, more risk, more return. That is true in most cases if you stay the course. The lower risk investments, these are the ones that may allow you to sleep at night, but they're not going to generate a higher return. So if you find that you have a longer term goal and you're in lower risk investments, you might not experience the growth that you're expecting. So one of the things we encourage is that we encourage all of our clients to make sure you diversify. So you maybe have a little bit of both, depending on your situation. But one strategy that most investors should consider is something called asset allocation. It's a way that you divide your dollars among the different categories, low risk, high risk, maybe some cash, depending on, again, your time frame and ultimately the goal that you're trying to achieve. And so let's look at some examples. Given where you are, depending on your age, there's generally a rule of thumb. If you take your age, subtract it from 100, that's percentage of you should be invested in stocks. So let's look at our first scenario here. We have a 25-year-old investor. We're suggesting if you're 25 years old, then maybe 75% of your money should be invested in stocks. And then look over to the 65-year-old investor. If you're in retirement or facing retirement, now here's an interesting piece. At 65, you still should have at least 35% of your money invested in stocks. Because some will say, well, I'm about to retire, or I'm in retirement, I don't need to take as much risk. Well, I would submit to you, most people will live longer in retirement than maybe they have worked. So at a 65-year-old, there's a chance you could live another 30 years. And so that's why it may be important for you to still have a third of your money, a little bit more than a third of your money still in the stock market. Again, it's going to be specific to the individual, but these are rules of thumb. And certainly if you're in the mid 40s, you could see half of your money should still be at least invested in the stock market. Dollar cost averaging. So one of the questions we've seen over the years is, when's the right time to invest? Maybe I should wait until the market slows down or picks up, or wait until we get back into a bull market. Because timing the market is not often a successful strategy, we encourage individuals to invest on a regular basis. And dollar cost averaging is a way that you can invest on a systematic basis. You can put money away every month. Most do it every pay period. If you're investing in your retirement plans, you're doing this. You're buying more stocks when the prices are lower, and then you're buying less stocks as the prices are rising. But over time, what this does is it gives you an average cost that should be less than the market. And we'll look at a slide later that will show you that over time, dollar cost averaging is the way to invest. So don't be concerned about timing the market. Get in, get started, and set up a systematic plan. Rebalancing. So if you find that you've accumulated assets in the market, first, congratulations that you are an investor and you have money that you've invested. The next thing we want to talk about is over time, your assets tend to fluctuate and they will shift based on what area of the market's been doing really well. If you look at where we are today, over the past 10 years, the growth equity markets have done really well. So if you have that balance that we talked about before, if you're 70 or 80% in the market, it might be 85 or 90% shifted to growth. This would be a good time to maybe rebalance. Maybe you sell some of what you've made a lot of money on, the growth, and reposition it into some less performing or some conservative. But rebalancing is something that you should do as part of your investment strategy on an ongoing basis. We suggest clients to look at it at least twice a year. So here's looking at investing over time. This gives you an example of $10,000 and how it would have grown over the past 20 years. And we're looking at different categories of investments. So we'll see the yellow is a treasury bond, which is a very conservative, income-oriented investment versus stocks, large company stocks, and small company stocks. And we have corporate bonds in there as well. But $10,000 invested in a treasury bond would have grown to $20,000 in the last 20 years versus if you had $10,000 and you were in small company stocks, that same 10,000 would have grown to $75,000. So more than doubled your money. And so this is one thing that we really try to drive home. Time in the market is very important. And if you can determine what your tolerance for risk is, we're saying, hey, in this scenario, someone who did not mind the fluctuations of the stocks did really well. Their 10,000 grew to 60, 75,000 versus someone who was very conservative. They could not sleep at night if the market fluctuated, which is fine, but your 10,000 only grew to 20,332. So I ask you, based on where you are, your age, how would your 10,000 have grown over time based on your risk tolerance? That's a question you want to answer. But this is a good slide to show you that over time, if you're willing to take the risk and you have time, it can certainly reward you. What drives the underlying price of the stock? So a number of things. So stocks are designed, as you know, the companies are growing, so they're making changes ongoing. You're going to be growing your money as the stock grows and the company grows, and a lot of things or factors are involved with that stock price growing. It could be buying other companies, innovative software, technology, et cetera, a lot of reasons. But as that price of the stock grows, you're going to be sharing in that growth as part owner, because buying the stock, you actually are a shareholder. Market capitalization pretty much gives us an idea of the size of the companies that you may own personally, or they may be inside of your investment vehicle. You may hear the terms large cap stocks, large capitalization. Those are going to be companies that are very large, like the Apples or the Microsofts, Home Depots of the world, or the mid-sized companies are going to be younger companies that may not have the size, they may not have the history of some of the other ones. Foreign stocks, you know, some companies that may be overseas that are still participating in the US markets. And then dividend paying stocks. These are going to be companies that are still well established. They may not be growth oriented. They may not have an iPhone or Microsoft or technology orientation, but it could be something that has a very well established brand like a Procter and Gamble or maybe a Coca-Cola or Kroger. Those companies, Walmart's another good example, they will pay the investors dividends as a result for being a shareholder versus relying on the company growing its market share. So those are going to be the types of categories of stocks that you're able to hold inside of your portfolios. Bonds are another type of investment. As we saw earlier, it is a less volatile investment. As a bondholder, you will be guaranteed a principal and interest as long as the bond issuer does not default. But typically a bond is an investment where you can invest, you will get interest on top of your principal back at maturity. But it's a great way to generate income on your portfolio. And this is also can be an integral part of a diversified portfolio. Types of bonds, US Treasury bonds are issued by the government. Very safe. Rates are going to vary depending on the term. You can get shorter term bond versus longer term. Corporate bonds, companies issue bonds as well. So you're going to have interest rates that are going to vary as well, depending on the strength of the company, strength of the issuer. Municipal bonds are issued by municipalities, cities and counties. Municipalities that offer you, states as well, issue municipal bonds. Those also, in some cases, will be tax-free. So it could be a strategy to avoid taxes, but still get a decent rate of return on your money. Cash alternatives. So cash is another piece that is an integral part of your overall portfolio. Cash obviously is the most stable. When we talk about cash alternatives, here we're thinking about something other than maybe a savings account. Maybe you can do a CD or a money market fund. One of the things that we encourage our clients to think about is as you start investing, you want to make sure you have adequate reserves or cash reserves on hand, because you don't want to disturb your investment portfolio if you have a short-term need. But if you find that you have a lot of cash lying around, you can use things like savings accounts, CDs, money market funds, still keep the safety, but also get a slightly higher rate of return on money that's very safe and available in event of emergency. What risk means to your portfolio. So as you build your portfolio or you evaluate your portfolio, these things are ongoing. So it's important that you be aware of it. Market risk is going to be sometimes things out of your control, but it's important to have a diversified portfolio to deal with these issues. Market risk will be something like maybe we have a situation overseas, there's a oil embargo or something going on in the oil market that may impact you if you hold oil stocks, or it may impact the economy itself. Economic risk is pretty much what we're experiencing now. As the economy changes, we currently are under an interest rate cycle where the Federal Reserve is raising interest rates. Those things will have implications on your investment portfolio as well. Specific risk speaks to an individual company per se. If you find yourself, some people we've learned over the years have a heavy concentration in the company that they work for. That's a specific risk, an example of a specific risk. Interest rate risk, kind of what we're experiencing now. If you're in bonds investments, as interest rates rise, those are going to impact the pricing of your portfolio. So be mindful of that. Credit risk is where, again, if you hold bonds, you have to think about the insurer, the person that's insuring the bond, making sure that that company's doing well, because that is credit risk as well. And then lastly, inflation risk. All that we're experiencing now, trying to manage the cost of living. What you don't want to do is basically sit. One example we talk about is not sitting there with a lot of money in a bank account or in an account, not earning anything. Because remember, inflation is growing. Inflation is growing every year. On average, historically, it's been between 2 or 3%. So if your money's not earning at least the cost of living, you potentially could be losing money safely, and you don't want to do that. So be mindful of the variety of risks that impact your portfolio. Diversify, certainly meet with your professional. Just be mindful of it and plan for it. Mutual funds. So when you're ready to invest, or if you're already invested, you may be familiar with mutual funds. Mutual funds basically is a pool of investments. It's an investment company that pools your investments with other investors. It's managed by a professional. So you don't have to worry about trying to pick the best stocks or the best companies or the best industry. Generally, if you decide to invest in a fund, that fund will have a research team, that will have a team of professionals that are selecting the stocks, buying and selling the stocks on your behalf, managing that portfolio. And in today's time, you see funds or index funds where the goal is to just perform according to the index. So depending on what you choose, if you're aggressive, you're conservative, there would be a benchmark index that the fund is built around to make sure your investments grow according to that index. Target date funds is another innovation in the retirement space. This will basically say, hey, I'm 40 years old, I want to retire in 25 years. That target date would be something that fund potentially could have, a 25-year retirement date. And it will, again, shift that portfolio on your behalf. They're doing the work behind the scenes. Your goal is just to keep investing, monitor your funds, but these mutual funds' job is to manage and take care of that portfolio on your behalf. Exchange traded funds are another type of investment, very similar to a mutual fund. It does not have as many people involved. The idea with the exchange traded funds is to give you more of a pure investment. And so you may have a pool of stocks that represent the exchange traded fund. It's still built by an investment company, but there's not much management going on. The fund generally will hold the same stocks until you sell the fund itself. And as a result of that reduced layer of management internally, you have less fees. And so this has become very popular because some people, while they like the idea of pooling their money inside of a fund for diversification reasons, they didn't necessarily want all the fees associated with a mutual fund. So that made exchange traded funds very popular. And it's an easier way. You can sell them, you can buy them the same day, get in and out of the market at minimal cost. And so that's another great opportunity for you to diversify your portfolio. Overcoming bad behavior. So one of the challenges of your success sometimes will be yourself. And so I really encourage everyone to understand big picture, what you're trying to accomplish. Try not to do this in isolation. Don't let it be a one-off venture. You got to make sure you fully understand kind of what you're up against. A lot of times, you hear the news, you see the markets on your internet, and people will say, hey, I want to buy that great stock. I heard about X, Y, and Z, and they'll just kind of jump. There's something in the market called FOMO, the fear of missing out. And you'll find yourself chasing the latest and greatest hot stock without really doing your homework, building your foundation. And so what we try to encourage our clients to do is to take a step back, think about what you're trying to accomplish, the things we talked about earlier, put your plan in place, and make sure it's working for you specifically. I will promise you that over time, if you stay invested, you generally will perform and do well. Most people have problems, or they fail, I shouldn't say fail, but they don't have the success in the market because of these reasons. They're chasing, they're panicking, not understanding some of the risks that we talked about. And so when these things happen, they're ill prepared. And as a result, they make rash decisions, emotional decisions that may cost you your long-term plans. So other factors as you do your planning, you want to make sure you don't have a long-term investment to deal with a short-term emergency. So we encourage to build a cash reserve. It's important to have money set aside that you don't need. Money that you do need, but money that you don't need right away can be invested. Those are the dollars you want to focus on your 5 and your 10-year goals. The money that you set aside at your bank should be there for your emergencies, so you don't have to disrupt a long-term investment plan to deal with a short-term need. And then the other thing you need to do as you consider your planning is to make sure you've dealt with the other unexpecteds in life. What if someone gets sick, someone's ill, or you get in an accident or something unexpected? You got to make sure that's factored into your financial planning as well, because those are the behaviors or incidents that could disrupt your long-term investment needs. Let's talk about another challenge, procrastination. So this looks at 2 investors. One is eager and excited. They've come to our presentation today and they're ready to take action. And so they have $25,000 and they've met with their professional and they looked at investing $5,000 right away for the next 5 years, earning 6%, versus the other person, same individual at the webinar with you, but they said, hey, I've got time, I can wait a while. So let's look at the difference of waiting 5 years. So you got one investor that started right away, put $5,000 away for the first 5 years. And again, they're both earning the same 6% on their money. 5 years later, the next investor decides to invest. And again, that same $25,000 over the next 5 years. So let's look at what happened after 10 years. And so you see the first investor who started right away had 5 more years of investing, compounding, working on their behalf, versus the individual who waited, procrastinated, same amount of money was invested, but time. And so that's really the message here. Time can be a huge factor in your success as an investor. We tell our clients, where you don't have time, you need more money. Where you don't have a lot of money, make sure you have time. So there's no better time than now to get started if you haven't. And if you're already investing, congratulations. Focus on some of the other things that we talked about, rebalancing, diversifying, to make sure your money's growing the way you expect it. But this procrastination, don't let procrastination be a hurdle for you. And so to sum it up, so I think investing there's a great opportunity. Our financial markets continue to be the best in the world. If you look at historically over time, the market has averaged 7 to 10%, depending on where you are on the risk scale. So I would submit to you that, pause, think about what you're trying to do long-term, but make investing part of any long-term plans that you have for saving, whether it be retirement, your kids' college, or you have your own short-term needs. Anything 5, 10 years where you need the money to grow, consider diversifying your portfolio or getting started if you haven't.
All right, we'll go ahead and open the floor up for some questions. And I do have some already coming in. And if you have a question, go ahead and put that in the chat. The first question is on those allocation examples that you gave with the stocks and the cash and the bonds. Can you talk a little bit about alternatives? What role does that play in a portfolio?
So alternatives are certainly another part of your diversified portfolio. That's probably going to be on a case-by-case basis. There's a lot of alternatives out there. There's some that are very popular today that will protect your downside because we are in a volatile market and give you an upside. So in the case of the market drops, you don't lose money, but you can have an alternative investment that gets you at least a portion of that index return. So I would encourage alternatives as a diversified portfolio, but it has to be part of an overall diversification strategy.
Thank you so much. Can you give some examples of alternatives just so people, in case they don't know about that?
So alternatives generally are going to be investments that are put together by an investment company. And most of the alternatives that I've seen are unique to the current economic environment. So as we've seen volatile markets currently, you may have an investment where you could, for example, take $100,000 and it may be the underlying investment may be a bond that's guaranteed by a bank, for example. They will guarantee you an 8.5% return on that money if you leave it for at least 12 months. If the market drops, you don't lose any money, but they also will have the option to do what they call take that investment out early, call it. So let's say on 100,000, in a perfect case, you let it sit for 12 months, you may earn 8.5% or $8,500. That alternative investment may have the option to call that bond early, and you may only earn half the money. So that's one alternative that I've seen happen. It works. I mean, it's still, maybe it's less money for you, but you didn't lose any money. And what you find is the alternative investment, if the markets are really volatile and things aren't working on behalf, or interest rates are changing, that may be a reason that the investment may pull it early. So it's a little intricate, and that's why I try to encourage people to look at it one-on-one with their advisor. But that's just one idea. The whole idea is no loss on your part. You have upside protection, but it could be limited based on market dynamics.
Thank you so much for that example. You talked about rebalancing. Someone had asked, how exactly does rebalancing happen? Do you have to do it yourself? Talk us a little bit through that process.
That's a great question. So rebalancing it could be self-directed. So if you're not working with a financial professional, generally people should look at it at least twice a year. And in most cases, it will be inside of your retirement plan, where most fund families or your retirement plans should allow you to log on and you can ask for them to rebalance, but you would need to know what preference you need for a diversification strategy. So if you have kind of what your percentages are, you can pretty much do it on your own. Or if you have the luxury to work with a financial professional, I would do it in collaboration with that professional.
All right. Have you ever found that people are maybe not taking enough risk in their portfolios? And how do you kind of overcome that nervousness to be in more risky investments?
Yes, I do find that people, sometimes people just kind of set it and forget it. They just start and they never look back at the investment, and time passes them by. I encourage, at least twice a year, or at a minimum, when it's renewal time with your company. Most people, if you're working, how you go through your annual benefits, that's a good time to look at your investments as well. But I encourage people to just think about what they're trying to do, be proactive, be part of the process, because a lot of times people just get started and they're not paying attention to what's going on. It's just hard, but at a minimum, I say once or twice a year, when it's time to renew your benefits, we try to use that as a trigger to also review your portfolio to make sure it's performing what it should. Ask yourself the question, how did the market do? Which is, I mean, this is information you can get on the web, and then compare that to your own portfolio and just see how well diversified you are. You should be at least performing what the stock market is performing if you're a long-term investor.
All right. Can you talk a little bit about how interest rates affect a portfolio? We've seen a lot of volatility in interest rates over the past couple of years.
So they're going to affect the portfolio in different ways. Generally, if you see a rise in interest rates, that would reduce equity prices because generally the cost of operating is more expensive. So normally you will see the stock market have a brief correction depending on the severity of the rate or the rate of the increase. And then for fixed income, because interest rates are rising, if you have a fixed interest rate today, as the price will drop as interest rates go up because now you can get a newer bond that's paying a higher rate based on the rise in rates. So that's the interest rate risk. But overall, you're going to see a change in your portfolio. In most cases, when they're trying to slow the economy down, there's usually a brief correction in the market. We've seen that from, I think, the end of 2021 until where we are today. And that's as a result of the Federal Reserve raising interest rates. You've seen your prices come down. That's generally what you'll expect to see.
All right. And then another question here. You talked a lot about the time value of money. Can you talk about as far as minimums it takes to get started and kind of how to get started if someone has not started investing?
Yes. So in today's time, I mean, minimums are really what you're able to start with, because to me, you can find mutual fund families out there that will have $50 a month minimums. You can start in your company retirement plan if you haven't started already. Most companies have 401ks. Recent legislation is going to make sure most companies have a retirement plan available for you. So if you got a job, that's one way you can get started. Most companies will offer, most large companies will offer you a match. So I encourage professionals or individuals to at least contribute what the company is matching. So that's a way to get started. So that's a retirement start. But if you find that you've got cash available right away on a monthly basis, I would align myself with a mutual fund family, find a professional that can help you get started. You can do some online programs. There's a lot of ways to get started. The minimums I've seen as low as $25. I would say 50 is probably a good number out there, $50 a month. But it has to be part of a systematic plan where you're doing something every month. So really, there's no reason why we can't get started, because it should be affordable for most people.
All right. And then hopefully that, can increase over time. It becomes a habit.
Yeah.
That's great. All right. Well, I think that's about all the time we have for questions today. I want to thank everyone for attending. And I want to thank Erwin for being our presenter today, and thank the organizations that have made this webinar possible today. To our attendees, look for an email soon with a link to the replay of this event. And you can share that with friends and family. I know that we've gone over a lot of information and you might want to rewatch it as well for yourself. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Well, we're getting some thank yous in the chat, and we want to thank you for being here too. We hope to see you at another webinar soon. Goodbye, everyone.
Bye. Thank you.